Hello, I'm Yutaka Watanabe, a tax accountant. This is the channel, Tax Accountant Nabe solves your money problems. This time, I will talk about tax audit, controlled foreign company rules for tax havens. Did you know that every year, an unbelievable amount of money, in other words, mass corporate profits, quietly moves across national borders? In fact, a significant portion of the profits of multinational companies doing business around the world is shifted to countries and regions called tax havens, where taxes are surprisingly low. Today, we will look together at how companies skillfully move those profits and at Japan's tax system that tries to stop that from happening, commonly known as the controlled foreign company rules for tax havens. In today's world, data, ideas, and intellectual property can cross oceans in an instant. That is exactly why this has become an extremely difficult problem for tax authorities around the world. Unlike the old business model of making and selling product in huge factories, the source of modern profits have become very difficult to grasp and highly fluid. Companies want to keep as much profit as possible in their hands, while countries want to collect fair taxes. Aren't you curious about what kind of tug of war is taking place between these two sides? That is where today's main character finally appears, the controlled foreign company rules for tax havens. Simply put, these are powerful rules created to stop intentional tax avoidance. If we only had ordinary domestic tax laws, it would be impossible to fully catch money that slips away across borders. So, this system works, in a sense, like a giant boomerang. If it firmly catches money that has been deliberately thrown far away to escape taxes and forcibly brings it back into Japan's tax net. This boomerang has two targets: Japanese domestic corporations and Japanese residents. Do you think only huge global companies use these complicated methods to reduce taxes? Actually, that is not the case. Individuals such as wealthy people with enormous assets also have a strong incentive to use overseas structures for tax-saving purposes. This system casts a wide and accurate net over both corporations and individuals. Now, let's follow the actual movement of money and see how this profit shifting is carried out. For example, suppose there is an IT company in Tokyo. Step 1. It targets a southern island or a similar location where the corporate tax rate is 0% or extremely close to 0%. Step 2. It establishes an overseas subsidiary in that tax-free paradise. Step 3. Massive license fees or consulting fees that should originally have gone to the Tokyo company are instead reassigned as sales of the subsidiary on that island. With this, profits smoothly move from Tokyo to the Southern Island. This is the typical mechanism of taking advantage of gaps in the law. The key phrase here is a paper company with no substantial business activity. Even if you visit that subsidiary on the southern island, there are no engineers at all. All that exists is a mailbox and some paper documents. That is what it means to have no substantial business activity. Is it a real business, or is it merely an empty box created only to avoid tax? This becomes the most important checkpoint for distinguishing legitimate global expansion from mere tax avoidance. Companies pay high legal fees to send profits to a southern island. They may feel relief, thinking, great, now we have saved tax. But the moment the controlled foreign company rules for tax havens are triggered, that situation is overturned by the harsh reality. Yes, this will be tax in Japan. The money that was supposed to have escaped is pulled back firmly by the power of the law. And in the end, it is calculated using Japan's higher tax rates. However, this does not mean that any company established in a low tax country will automatically be penalized. The important point is that the rules are triggered only when certain requirements are met. A Japanese automobile manufacturer that built a factory in Southeast Asia hires local workers and sells cars. There is conducting genuine economic activity with substance. So, it falls outside the target of this tax system. It is a very precise system that specifically targets unfair tax avoidance using paper companies. So, how is the tax actually imposed? First, the profit supposedly earned by the overseas paper company is treated as if it had been earned directly by the Japanese parent company. Next, the amount is combined with the original profit of the Japanese parent company, and Japan's tax rate is applied to the total amount. But you may think, wouldn't that result in double taxation? No need to worry. There is a system called the foreign tax credit, which allows taxes paid locally to be deducted later. As a result, the final tax burden can be fairly adjusted to the level of Japan's proper tax rate. Now, as business globalized at the incredible speed, how will tax rules continue to adapt to these changes? If some people manage to avoid taxes, the national budget becomes short by that amount, and eventually the burden comes back around to ordinary taxpayers like us. For now, the controlled foreign company rules for tax haven are the strongest difference. But when the time comes when business becomes completely digital and companies and factories all exist on the cloud, where exactly will profit be located? The digital economy continues to evolve, and tax authorities continue chasing after it in a never-ending game of cat and mouse. Please keep an eye on how this global tax battle develops from here. This time, I talked about tax audit, controlled holding company rules for tax havens. For tax audit, please also visit the page of Yutaka Watanabe, Tax Audit, Tax Accountant Office. I will continue talking about topics related to money, so please subscribe to the channel. Tax Accountant Nabe solves your money problems.